Hello, my name is David O'Dell, and I am a senior manager with Wegner CPAs in our Madison, Wisconsin office. This recording is based on my presentation that was part of our firm's not-for-profit roundtable series in 2017. I am making this recording in March 2018, but I originally presented this topic in July 2017 and repeated it a few times in August and September. Our firm received a number of inquiries from people who were not able to make it to one of our roundtables, so I was asked to record my presentation so we could make it available on our website, so here I am. Before I start, I just wanted to let everyone know there are two handouts for this presentation. The first handout is a copy of the PowerPoint slides. The second handout is titled Exhibits and includes various examples of the matters I'll be discussing during the presentation. You can follow along with the video because I'll be going back and forth between the slides and the exhibits. You can also download these handouts from our website. There should be links to the two PDF files located on the page of our website where you found this recording. So let's get started. The topic of my presentation is the new not-for-profit financial statement standard that was a result of this FASB project. If you're not familiar with that acronym FASB, it stands for the Financial Accounting Standards Board. The FASB is the body that establishes financial reporting standards for non-governmental entities, which includes public and private companies and not-for-profit organizations. A quick background on the FASB. When it decides to take on a particular issue like this one, it puts a project on its agenda, meets with various stakeholders, and deliberates on the matter, often for a number of years. This particular project was added to the FASB's agenda in 2011, and here are some of the objectives the FASB had for this project. If you have seen any materials or press releases or attended any seminars about this topic, some of these objectives may look familiar, particularly the first one and the last one. The first one is that this standard is intended to be an update, not an overhaul of the current financial reporting model for not-for-profit organizations. The FASB believes the current reporting model, which has been in place for about 20 years, is sound. The new standard does not change recognition or measurement of transactions. It is primarily about presentation and disclosure of information in the financial statements. So one question that has been frequently asked is, do I need new accounting software to implement this standard? The answer is no, you will not need new accounting software just to implement this standard. You may, however, need to make some changes to how you track certain information, and I'll talk about such possible changes as I talk about specific requirements. The last objective on this slide is to better enable not-for-profit organizations to tell their financial story. The FASB wants not-for-profit organizations to be able to provide more relevant information about their resources to donors, grantors, creditors, and other users of financial statements. Throughout the project, the FASB met with various stakeholders such as industry and advisory groups, public accountants and auditors, and others. The bullet points on this slide are some of the concerns voiced about the current reporting model. For example, the first bullet point, if you are familiar with the current three classes of net assets, there's a class called unrestricted net assets. Well, the word unrestricted does not necessarily mean those net assets are free of limitations and available for current operations. I'll talk about net asset classes first as I go through the areas of change. But based on its research, the FASB concluded what users of not-for-profit financial statements basically want to know is, one, how not-for-profit organizations use their resources, and two, what resources they have available to them. So the result of this project was the standard that was released in August 2016 and becomes effective in a little less than a year. I'll talk more about the effective date towards the end of this presentation. The new standard makes changes in these 5 areas. So for each area, I will discuss what is currently required and then discuss how the new standard makes changes to those requirements. So the first area I'll cover is net asset classes. I'll start with a few definitions. Many professions have their own language, and accounting is no different. You may see words that have a general meaning in plain English, but have a more specific meaning when used in a particular profession. When I meet with clients or make presentations to boards of directors, I often say one of my jobs is to be a translator, that is, translating accountant into English. So the terms on this slide all relate to putting limits on a not-for-profit organization's resources. The new standard does not change these definitions, but it is important to understand the differences between these terms. The first definition is a condition. A condition is a donor-imposed barrier that must be overcome before a promised gift becomes a contribution. A common example of a condition is a donor's matching requirement. For example, a donor might say, I'll donate $500,000 to your organization if you first raise $500,000. With conditions, the donor's instructions focus on first achieving specified outcomes as opposed to providing instructions on how the funds should be spent. When a donor's instructions include a condition, no contribution is recognized by the organization until the condition is met. I mentioned earlier that the new standard does not change when transactions are recognized in the financial statements, so this definition is not mentioned in the new standard. The next two definitions, however, figure prominently in the new standard. The next definition is a restriction. A restriction is a donor-imposed stipulation that a contribution must be used for something that is narrower in scope than the mission of the organization. For example, a donor may make a contribution to fund a specific program service or a particular project, like constructing a new building. A couple items worth mentioning about the definition of a restriction. Like a condition, a restriction is donor-imposed. Also, the definition indicates restrictions apply to contributions. However, restrictions may also apply to investment income earned on restricted contributions. For example, a donor may establish an endowment fund with an organization. The donor's original contribution is restricted because the organization must hold it in perpetuity. The donor may also indicate that the investment income earned on the endowment fund must be used for a particular purpose. One thing not mentioned on this slide is that there are two types of restrictions. There are purpose restrictions, such as restricting a contribution for use in a particular program service. There can also be time restrictions. The most common example of a time restriction is a pledge paid over multiple years. For example, a donor may make a $25,000 pledge and indicate that it is payable $5,000 each year for the next 5 years. Those payments that are due in future periods are restricted by time. The last definition is a designation. A designation is a voluntary, board-approved segregation of net assets without restrictions for a specific purpose, project, or investment. Designations are when the organization takes its own funds, that is, those funds not restricted by donors, and sets them aside for whatever reason. A common example is setting aside funds for an operating reserve. Another example is an organization that owns its building may set aside funds for future capital improvements. You may have also heard the term board-designated or quasi-endowment, where an organization sets aside its own funds to act as an endowment fund. So the key difference between these last two definitions is that restrictions are externally imposed by donors, while designations are imposed internally by the organization. Now, let's talk about what's currently required. The title of this slide includes another acronym, GAAP. If you're not familiar with that acronym, it stands for Generally Accepted Accounting Principles. GAAP is those financial reporting standards I mentioned when I was talking about the FASB. To tie those two acronyms together, the FASB is the body that establishes GAAP. So current GAAP requires not-for-profit organizations to report net assets in one of three classes depending on the presence or absence of donor restrictions. I mentioned the unrestricted class earlier. There's also a temporarily restricted class, such as contributions restricted for use in a particular program, and a permanently restricted class, which is basically the principal amount of an organization's endowment funds. Current GAAP also requires not-for-profit organizations to disclose information about the nature and amounts of temporary and permanent restrictions. Finally, unrestricted net assets may be subdivided into board-designated and undesignated amounts, and disclosing information about designations is permitted but not required. So, what does the new standard change in this area? First, it takes the existing 3 classes of net assets and reduces them to 2. There's now a class called net assets with donor restrictions and a class called net assets without donor restrictions. The new classes focus on the word donor to make it clear who is imposing the restrictions. In the exhibits I mentioned earlier, at the top of page 1, Exhibit A includes an example of the net assets section of the Statement of Financial Position. Under current GAAP, the 3 classes of net assets are presented as applicable, and this example includes all 3. To convert to the new standard, simply change the description of unrestricted net assets to net assets without donor restrictions. In this example, the 2 restricted classes of net assets would then be combined into a single class called net assets with donor restrictions. For most organizations, this change will be relatively simple. The next change is enhanced disclosures about the composition of net assets with donor restrictions and how the restrictions affect the use of resources. Again, Exhibit A includes an example of such disclosures under current GAAP and how those disclosures may look under the new standard. In addition, Exhibit J on page 10 of the exhibits includes an example note that provides information about the nature and amounts of different types of donor-imposed restrictions. This example, like many of the exhibits, comes directly from the FASB standard. This example includes many types of donor restrictions, such as purpose restrictions, time restrictions, and restrictions related to endowment funds, and maybe more than what's needed for your particular organization. But it does give you an idea of what the FASB means by enhanced disclosures. The intent is for an organization to provide more useful information to a financial statement user about restrictions on the organization's resources. The last change in this area is the amounts and purposes of designations of net assets without donor restrictions are required to be disclosed. The new standard does not require an organization to make designations, but if designations are made, they must be disclosed. Like the disclosure requirements related to restrictions, the intent here is to provide more information about limitations on an organization's resources. So back to Exhibit J. Note DD at the bottom of this page is an example of a note that provides information about the amounts and purposes of board designations. Likewise, the note at the bottom of Exhibit A includes information about designations of net assets. The last change here indicates a need to have policies and or procedures regarding designations. Such policies are recommended as a best practice but are not required by the new standard. However, it is a good idea to have something in place not only for current management and current members of the board, but for future management and future members of the board. For example, if an organization sets up a board-designated endowment fund, the organization should document the reasons for establishing the fund and how it intends to spend from the fund. Such documentation could be made in the minutes of the meetings of the board of directors or as a separate policy statement. That way, future members of the board or management have a better understanding of why such funds were set aside. For many organizations, combining the restricted classes of net assets and renaming the classes may be the only change to their financial statements. However, the new standard includes some additional requirements for underwater endowment funds. Underwater endowment funds is not a new concept, but there is now a definition provided by the FASB. An underwater endowment fund is a donor-restricted endowment fund for which the fair value of the fund is less than the amount required to be maintained by donor or by law. For example, a donor may give $100,000 to an organization to establish an endowment fund. The organization will most likely take that $100,000 and invest it in a portfolio of stocks, mutual funds, etc. If the value of those underlying investments dips below the original amount, say in this example the value of the investments dipped to $90,000, you have an underwater endowment fund. In this example, the endowment fund would be underwater by $10,000. So current GAAP requires the deficit of a donor-restricted endowment fund to be included in unrestricted net assets. An organization may have a single endowment fund, or it may have multiple endowment funds depending on the circumstances. Regardless, when accounting for endowment funds, you first account for each individual endowment fund, determine whether it is underwater or above, and then you aggregate the information for reporting in the financial statements. Thus, under current GAAP, you may have amounts related to endowment funds spread over all three classes of net assets. The new standard requires the deficit of a donor-restricted endowment fund to be included in net assets with donor restrictions. Thus, under the new standard, all donor-restricted endowment funds are housed under the class net assets with donor restrictions, while all board-designated endowment funds are housed under the class net assets without donor restrictions. So the presentation of endowment funds is a little cleaner than current GAAP. Along with this new way to account for underwater endowment funds, there are some new disclosures required if you have underwater endowment funds. If you already have endowment disclosures, you know that they may be quite lengthy. The new standard basically adds on to the disclosures currently required. Exhibit O on pages 16 and 17 of the exhibits is an example of a note to the financial statements that discloses information about endowment funds. The underlying text in this note is examples of the new disclosure requirements. For example, the underlying text toward the end of the interpretation of relevant law paragraph on page 16 is an example of the first bullet point on the previous slide. One more acronym you may have heard of is UPMIFA, which stands for the Uniform Prudent Management of Institutional Funds Act. It is basically the law that has been enacted by most states. I believe all of Pennsylvania have enacted a version of it that governs management, investment, and spending of donor-restricted endowment funds. It supersedes a law that, among other things, was more restrictive in giving organizations the ability to spend from underwater endowment funds. So a sentence such as the text underlined in this paragraph should be sufficient to meet the disclosure requirement. The last paragraph on page 17 includes an example of policies and any actions taken during the year concerning appropriation or spending from underwater endowment funds. In this example, the organization normally spends 5% of its endowment, but this year it only spent 3% from funds that are underwater. Finally, the paragraph on page 17 under the heading Underwater Endowment Funds is an example of the last three bullet points on the previous slide. Basically, there are some amounts regarding underwater endowment funds that need to be disclosed in the financial statements. The first amount is the aggregate fair value of underwater funds. The second amount is the aggregate of the original gifts or the level required to be maintained by the donor or by law. The third amount is the aggregate amount by which the funds are underwater, which is the second amount less the first amount. So what are some things to consider when implementing the changes in the net asset classes area? You should determine if you need to adjust accounts in your general ledger, spreadsheets, or other tracking mechanisms to accommodate the new terminology and presentation of net assets and endowment funds. You should determine the level of disaggregation you want to present in your financial statements to provide information about restrictions on and designations of net assets. And you should assemble information about any designations of net assets. I generally recommend that any designations of net assets should at least be approved in the minutes of the meetings of the Board of Directors. However, you may also need to have formalized policies about how funds should be set aside and used. Now, some information in this area may tie to the next area, which is liquidity and availability of resources. For the other four areas I'm going to talk about, I can easily show you what's required under current GAAP and what's changed in the new standard. While this area is not a new concept, I'll say it's a newer concept because current GAAP does require disclosure of certain information related to liquidity and availability of resources, but nothing that's really comparable to what's in the new standard. This area may be the most challenging one because it goes beyond the usual financial data that's included in financial statements and is more focused on financial management issues. So I'll jump right into the new standard. There are two general requirements in this area. The first is the organization needs to disclose qualitative information on how it manages its available liquid resources and its liquidity risk. This information will be presented as some form of narrative in the notes to the financial statements. This requirement is related to the objective I mentioned earlier about enabling organizations to tell their financial story. I alluded earlier to how net assets does not necessarily mean liquid assets. For an example, an organization may have net assets of $5 million. If you focus on just that amount, you may not realize that $4 million is tied up in the organization's property and equipment, which is not a liquid asset. You may also not realize that a large portion of the remaining $1 million is subject to donor-imposed restrictions. So this requirement can help explain limitations and helps make such information more prevalent to users of the financial statements. The second requirement is to present quantitative information, which can either be on the statement of financial position, in the notes to the financial statements, or a combination of both, that communicates the availability of the organization's financial assets to meet cash needs for general expenditures within 1 year of the date of the statement of financial position. So let's stop and break down this requirement. The term financial asset is defined by the FASB. I'll quickly read you the definition. A financial asset is cash, evidence of an ownership interest in an entity, or a contract that conveys to one entity a right to either receive cash or another financial instrument from a second entity, or exchange other financial instruments on potentially favorable terms with the second entity. It's probably easier to give you some examples of financial assets. Cash is a financial asset. All types of receivables, such as trade accounts receivable, pledges or promises to give, and notes and loans receivable are financial assets. Most investments, such as stocks, mutual funds, ownership interests in partnerships, and so on, are financial assets. Some examples of assets that are not financial assets: land and buildings are not financial assets. Materials and supplies inventories are not financial assets. Prepaid expenses or intangible assets such as patents, trademarks, etc. are not financial assets. So while the term financial asset is defined by the FASB, the term general expenditures is not and may need some interpretation. For example, funds restricted by donors or limited by contractual agreements or certain designations are not considered available for general expenditures. However, endowment funds where the investment income is not purpose restricted may be available. It's probably easiest just to go through some examples, and there happens to be a few examples in the new standard. One of the reasons this area may be the most challenging one is there's no laundry list of the types of information to disclose. However, these examples give an idea of what should be included. For example, an organization might explain its responsibility to maintain resources to meet donor restrictions. An organization's goals for maintaining financial assets might include establishing an operating reserve or enacting a policy to keep financial assets on hand to meet a certain number of days' normal operating expenses. For the next to last bullet point about agreements, a common example in Wisconsin is certain not-for-profit organizations may elect what's called the reimbursement method of financing unemployment benefits. Under this method, the organization does not pay quarterly unemployment taxes, but instead files an assurance of reimbursement with the state government. This assurance may be in the form of a bond, a letter of credit, or a certificate of deposit. So if an organization is maintaining a certificate of deposit to fund these benefits, that's an example of a financial asset, the certificate of deposit, that is unavailable to fund general expenditures because of the organization's agreement with the state government. Let's take a look at the exhibits. Exhibit L on page 12 is an example of a gross presentation of the quantitative information. The table after the first paragraph starts with total financial assets at year end. It then subtracts amounts that are not available for general expenditures within 1 year due to various reasons such as donor-imposed restrictions,
contractual limitations, and board designations to arrive at financial assets available to meet cash needs for general expenditures within 1 year. One question that was asked during the roundtables was if an organization needs to disclose an estimate of the amount of general expenditures it expects to incur within 1 year. The answer is no. The only amount that needs to be disclosed is the amount of financial assets at year end that are available for such expenditures. The paragraphs before and after the table in this exhibit include both qualitative and quantitative information about liquidity and availability of resources. For example, the last paragraph mentions the organization is substantially supported by restricted contributions. It also mentions the organization has designated an amount for a liquidity reserve and that it has a line of credit that can be drawn upon in the event of an unanticipated liquidity need. Exhibit M on page 13 is an example of a purely narrative disclosure. This exhibit first shows the organization's statement of financial position and then a paragraph for the note to the financial statements. This paragraph first discloses the financial assets available within 1 year of the balance sheet date to meet cash needs for general expenditure. It then explains the organization has a goal to maintain financial assets on hand to meet 60 days of normal operating expenses. And like the previous example, this paragraph mentions the organization has lines of credit that could be drawn upon in the event of an unanticipated liquidity need. Finally, Exhibit N starts with the organization's statement of financial position on page 14. This statement is an example of a classified statement of financial position where assets and liabilities are separated into current and non-current amounts. The note on page 15 is an example of a net presentation of the quantitative information as opposed to the gross presentation in Exhibit L. This presentation just lists the financial assets available within 1 year of the balance sheet date for general expenditure. The following paragraphs go on to explain matters such as limitations related to the organization's endowment funds, its policy for investing cash in excess of daily requirements, and available lines of credit. So these exhibits show that the disclosure requirements for this area can be satisfied in a variety of ways, which is another reason this area may be the most challenging area to implement. If you're wondering how to go about implementing the standard, this area may be a good place to start because it may require information that is not currently being tracked. I will discuss the effective date and adoption of the standard in more detail toward the end of this presentation. However, this area is one the organization can adopt early. One article I read while preparing for this presentation suggested first determining what financial assets the organization has available for general expenditure. If the organization finds itself in a deficit position, it may consider delaying the early adoption of the standard and instead focus on improving its financial assets position. Finally, like the net asset classes area, the organization may need to develop, assemble, or formalize its policies for managing liquidity. The next area relates to reporting expenses. Like the net asset classes area, I'll start with a couple definitions. Again, these definitions are not changed by the new standard. The first definition is functional classification. Functional classification is a method of grouping expenses according to the purpose for which costs are incurred. You may be familiar with functional classifications such as program services, management in general, and fundraising. The second definition is natural classification. Natural classification is a method of grouping expenses according to the kinds of economic benefits received in incurring those expenses. The natural classification is what people may typically think of when classifying expenses, such as salaries and wages, employee benefits, professional services, supplies, and so on. It may be helpful to look at Exhibit C on page 3 of the exhibits. This exhibit is an example of a statement of functional expenses. In this statement, the functional classifications are the columns for program services and supporting activities, while the natural classifications are the rows. There's one other definition we should cover, and that is a voluntary health and welfare entity. So under current GAAP, there's this special category of not-for-profit organizations called voluntary health and welfare entities. The primary reason I included this definition is just to show you how dreadful it is and why it creates confusion in this area. You may notice in the middle of this slide I even omitted some of the definition, but some parts to focus on are they derive their revenue primarily from voluntary contributions from the general public, and their purposes connected with health and welfare and community services. So it's probably easier just to give you some examples. My guess is that most of you are familiar with these organizations. Some of you may even work for one of these organizations. But another reason the definition of voluntary health and welfare entities causes confusion is it's not the same as the definition used by the IRS for charitable organizations. You may be familiar with the term 501c3 organization. I'd say most, if not all, voluntary health and welfare entities are 501c3 organizations, but you can be a 501c3 organization and not be a voluntary health and welfare entity. The good news is the new financial statement standard basically makes this definition irrelevant. So I'll first talk about what's currently required for reporting expenses. First, all not-for-profit organizations are required to report expenses by functional classification. This information may be reported either on the face of the financial statements or in the notes to the financial statements. For the second requirement, current GAAP requires all not-for-profit organizations to present three basic financial statements: a statement of financial position, which is the balance sheet of an organization; a statement of activities, which is the organization's statement of income and expenses; and a statement of cash flows. For that special category of voluntary health and welfare entities, they are required to present a fourth financial statement, a statement of functional expenses, which is Exhibit C that I showed earlier. Basically, a statement of functional expenses shows expenses by functional and natural classifications in this matrix format. Finally, under current GAAP, not-for-profit organizations other than voluntary health and welfare entities are encouraged but not required to provide information about expenses by natural classification. In other words, under current GAAP, only voluntary health and welfare entities are required to provide information about expenses by natural classification. So what changes with the new standard? First, all not-for-profit organizations are required to present an analysis of expenses by functional and natural classifications in one location, either on the face of the statement of activities, as a separate financial statement, or in the notes. For this analysis in one location, all not-for-profit organizations, including those voluntary health and welfare entities, now have the same requirement and the same options. This analysis most likely will not be presented on the face of the statement of activities unless your organization is relatively small. For example, if your organization has only one program service, one supporting activity, and not many natural classes of expenses. Most likely this analysis will be a separate financial statement or presented in the notes. So Exhibit E on page 5 of the exhibits is an example of a single column statement of activities. Expenses on this statement are reported only by their natural classification. Exhibit F on page 6 of the exhibits is an example of a multi-column statement of activities for the same organization. Expenses on this statement are reported only by their functional classification. Now, you could switch these presentations, that is, report expenses by functional classification on a single column statement of activities, or report expenses by natural classification on a multi-column statement of activities. Any of these presentations are acceptable. Just keep in mind that at this point, the new requirement to present an analysis of expenses by functional natural classifications in one location has not been met. For this example, that analysis is included in the notes to the financial statements as shown on Exhibit K. This analysis could also very easily be presented as a separate financial statement. So Exhibit K also shows an example of the second change in this area, which is not-for-profit organizations must describe the methods used to allocate costs among program and support functions. Most not-for-profit organizations currently have a general disclosure about allocation of costs. The new standard requires a little more specific information. For example, the paragraph after the table in Exhibit K explains the expenses that are allocated include depreciation, interest, and office and occupancy, which are allocated on a square footage basis, as well as salaries and benefits, which are allocated on the basis of estimates of time and effort. So you don't need to include a detailed description of your cost allocation plan. You just need to provide some information so users of the financial statements have a general understanding of how certain expenses are allocated rather than directly charged to the organization's program services and supporting activities. The last slide for this area comes directly from the new standard. It says to enhance the consistency of the allocation of expenses to program services and supporting activities, the FASB provided examples that differentiate activities that constitute direct conduct or direct supervision of program activities from activities that are classified as management in general. In other words, when allocating expenses, management in general is the default functional classification, and expenses should be reported as management in general expenses unless they relate directly to a particular program service or other supporting activity, or can reasonably be allocated to a particular program service or other supporting activity. The new standard includes examples for the costs related to the Chief Executive Officer, the Chief Financial Officer, the Human Resources Department, and for grant accounting and reporting. These examples are included in Exhibit P on page 18 of the exhibits. So let's go over the first example to give you an idea of what is meant by direct conduct and direct supervision of program or support activities. Since this example illustrates the allocation of expenses related to the activities of the Chief Executive Officer. It says the broad responsibilities of a Chief Executive Officer generally include administrative and programmatic oversight. At not-for-profit entity A, the Chief Executive Officer spends a portion of time directly overseeing the research program. Additionally, a portion of time is spent with current and potential donors on fundraising cultivation activities. A portion of the Chief Executive Officer's compensation and benefits and other expenses would be allocated to the research program and to the fundraising function, representing the portion of time spent on those activities because they reflect direct conduct or direct supervision. If the remainder of the Chief Executive Officer's time is spent indirectly supervising the other areas of the organization, including the administrative areas, those activities would not constitute direct conduct or direct supervision, and the ratable portion of compensation and benefit amounts would remain in management and general activities. So when implementing the changes in this area, a lot depends on what you're doing now. For example, if you are a voluntary health and welfare entity, you are already presenting an analysis of expenses by functional and natural classifications in one location on the Statement of Functional Expenses. Other organizations are currently presenting this analysis as a supplemental schedule of functional expenses. If so, those organizations can move that supplemental schedule and present it as a separate financial statement. Other organizations not currently presenting this analysis will have more work to do. You may need to make enhancements to your chart of accounts or your accounting software to assist in generating an analysis of expenses by function directly from the general ledger with minimal edits outside of the system. And finally, you may need to develop, revisit, or formalize your allocation methods to be able to provide the specific information required by the new standard. This next area about the statement of cash flows is the area with the least amount of change. Unfortunately, it's mostly that accountant speak I was talking about at the beginning of the presentation, so I'll do my best to translate. Now, the requirement to include a statement of cash flows is not changing. If you're familiar with the statement of cash flows, you know it includes three sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The changes in the new standard only relate to the operating activities section. If you're familiar with the operating activities section, you may know there are two methods that can be used to prepare that section. One method is called the direct method, while the other method is called the indirect method. When I polled the audiences at our nonprofit roundtables, I'd say at most half the audience knew what I was talking about when I mentioned the direct and indirect methods. So, Exhibit I on page 9 of the exhibits presents a side-by-side comparison of the direct and indirect methods of presenting the cash flows from operating activities section of the statement. The direct method on the left shows cash receipts from various sources and cash payments for various purposes. The indirect method on the right side starts with the change in net assets from the statement of activities and then shows a series of reconciling items to arrive at net cash provided or used by operating activities. Under current GAAP, if the direct method is used, a reconciliation of the change in net assets to net cash flows from operating activities is required to be presented in a separate schedule. So basically, the direct method currently requires preparation of the operating activities section using both methods. So what did the new standard change? Under the new standard, not-for-profit organizations are still permitted to present cash flows from operating activities using either the direct method or the indirect method. However, to encourage greater use of the direct method, the new standard eliminates the requirement to provide a reconciliation of the change in net assets to net cash flows from operating activities for organizations that use the direct method. So under current GAAP, if you use the direct method, your statement of cash flows would look something like Exhibit G on page 7 of the exhibits, plus the indirect method section on the right side of Exhibit I on page 9. Under the new standard, the statement of cash flows using the direct method would just include Exhibit G. The statement of cash flows using the indirect method would look something like Exhibit H on page 8 of the exhibits, and the statement using the indirect method would look the same under the new standard as it does under current GAAP. I mentioned on this slide that the FASB is encouraging greater use of the direct method. Some quick background on the FASB and how an accounting standard such as this one gets issued. The FASB is kind of like the Supreme Court in this sense. The governing board of the FASB consists of 7 members. In order for an accounting standard to be issued and become GAAP, at least 4 of the 7 members must vote in favor of issuing the standard. The actual document of an accounting standard typically starts with a summary of the standard. The bulk of the document then outlines all the specific changes or amendments. After that, there is usually a section that provides background information on the standard and the basis for the conclusions reached by the board. This section summarizes the board's deliberations and, if applicable, explains any dissenting votes on the standard. For this particular standard, there was only one dissenting vote, and it appears the only reason for that dissenting vote had to do with continuing to allow organizations to use the indirect method of presenting cash flows from operating activities. In an earlier draft of this standard, the FASB actually removed the option to use the indirect method, but after receiving comments from the public, it backed off from that change for whatever reason and decided as a compromise to continue to permit use of the indirect method, but allow organizations using the direct method to eliminate the reconciliation. So the FASB really wants the organizations to use the direct method, and I can understand why. If you compare the two methods, the direct method is probably more understandable by the average user because it reports information about cash received from customers, donors, and other sources, and cash paid to suppliers, employees, and others. instead of reporting a list of accounting reconciliations. That being said, I will say the indirect method is easier and less time-consuming than the direct method. So for no other reason than that, most small and mid-sized organizations use the indirect method to prepare their statement of cash flows. So when implementing the new standard, the only decision to make in this area is which method to use for the operating activities section of the statement of cash flows. If you are currently using the direct method, you can just eliminate the reconciliation required under current GAAP. If you are currently using the indirect method, determine the usefulness of the direct method and the cost to implement it. You may decide to change to the direct method or just continue using the indirect method. The last area I'm going to discuss relates to reporting investment return. The changes in this area primarily relate to improving the comparability of information about investment return across organizations. They also simplify the presentation of investment return. So let's start by discussing what's currently required in this area. First, investment revenues may, emphasis on the word may, be reported net of related expenses. So under current GAAP, investment-related expenses could be reported in the revenue section of the statement of activities or in the expenses section. Next, if netted, the amount of those expenses must be disclosed. This amount could be disclosed on the face of the financial statements or in the notes to the financial statements. For the third bullet point, it may be helpful to look at Exhibits B and C on pages 2 and 3 of the exhibits. It says here that investment expenses must be included in a statement or schedule of functional expenses if that statement or schedule is presented. For example, Exhibit B is an example of a statement of activities. In the revenue, gains, and other support section of this statement, there is a line called investment income net. So in this example, investment expenses are being netted against investment income. Exhibit C is an example of a statement of functional expenses for the same organization. There is a natural expense classification called investment fees on this statement. Now, since investment expenses are netted against investment income on the statement of activities, the statement of functional expenses needs to include the line toward the bottom, subtracting expenses netted against revenues on the statement of activities in order to reconcile the total expenses included in the expenses section of the statement of activities. Finally, under current GAAP, the components of investment return, such as investment income like interest and dividends, realized gains and losses on certain investments sold, and unrealized gains and losses, that is the market fluctuations on investments being held, must be disclosed. So what's changing with the new standard? The first change is that investment return is reported net of external and direct internal investment expenses. Basically, all not-for-profit organizations will now report investment return net of related expenses. This change refers to external and direct internal investment expenses. External expenses are expenses such as custodial fees or fees paid to external investment advisors or managers. My guess is that most small and mid-sized not-for-profit organizations only incur external investment expenses. However, some organizations may manage their investments in-house, so direct internal expenses would include expenses such as the salaries and benefits of employees responsible for developing and executing an organization's investment strategy. The second change is the amount of investment expenses that have been netted is no longer required to be disclosed. One reason for this change is certain investment vehicles like mutual funds and hedge funds have management fees embedded in the investment return. So depending on the types of investment vehicles used by an organization, comparing the amount of investment expenses between organizations would not necessarily be an apples-to-apples comparison, so the FASB just eliminated this requirement. The third change is the new standard eliminates requirements for several disclosures about investment return. For example, the components of investment return mentioned in the last bullet point on the previous slide no longer need to be disclosed. Likewise, for those organizations with endowment funds, the new standard eliminates the requirement to separate investment return on endowment funds into investment income and net appreciation or depreciation. The last change is that investment expenses netted should not be included in the analysis of expenses by functional and natural classifications. For this change, let's go back to Exhibits B and C. I previously mentioned this organization is already netting investment expenses against investment income, so nothing needs to be done to this statement of activities under the new standard. For the statement of functional expenses, since investment expenses netted should not be included in the analysis of expenses by functional and natural classifications, the investment fees line on this statement should be deleted. It is then not necessary to include the line that reconciles expenses on this statement to the statement of activities. One other change worth mentioning is the new standard distinguishes between programmatic investing and total return investing. Like some other areas I've covered in this presentation, programmatic investing is not a new concept, but there's now a definition provided by the FASB. Programmatic investing is the activity of making loans or other investments that are directed at carrying out an organization's purpose for existence rather than investing in the general production of income or appreciation of an asset. The definition provides the example of loans made to lower income individuals to promote home ownership. And this definition is similar to the definition of program-related investments on IRS Form 990. The important distinction to make is the purpose of the investment determines whether the investment is programmatic investing or total return investing. It's not how the investment income is generated and used. For example, an organization may have a portfolio of investments such as mutual funds or stocks in publicly traded companies. It then uses the income generated from that investment portfolio to fund its program services. That is not programmatic investing. Programmatic investing is when the investment itself furthers an organization's program service. The standard gave the example of loans made to lower income individuals to promote home ownership. As those loans are repaid, there will most likely be an interest component to the payment. That interest income would be reported as income from programmatic investing rather than investment returned as discussed in the previous examples. The reason it is important to distinguish between programmatic investing from total return investing is the new requirements described on the previous slide do not apply to programmatic investing. Instead, if applicable, an organization would include a separate line for programmatic investing return in the revenue section of its statement of activities. Any expenses related to programmatic investing would most likely be included as program service expenses on the analysis of expenses by functional and natural classifications. So, to implement the changes in this area, an organization should most likely establish procedures to accumulate investment expenses to be netted. An organization will most likely separately track the components of investment return and investment expenses internally, such as in separate general ledger accounts, for a couple reasons. One, the organization may want to perform an internal analysis of its investment expenses, such as comparing the amount of expenses incurred from year to year. Another reason is one thing that is still unknown is if or how the IRS will change the Form 990. Currently, the components of investment return are reported separately on the Form 990, and investment management fees are reported with other expenses. In the past, the IRS has revised the Form 990 to conform to significant changes made by the FASB, and the FASB has made the IRS aware of the changes in this new standard. I just haven't heard anything yet from the IRS about changes to the Form 990. If any changes are to be made, I don't expect them until at least the return for the 2018 tax year. I say that because of the last topic I'm going to cover in this presentation, and that is the effective date and adoption of the standard. The first bullet point on this slide is how the effective date reads in the standard. Accounting standards have to take into consideration different fiscal years and organizations, usually larger ones that prepare interim financial statements such as quarterly financial statements. So to translate, the standard is effective for financial statements for calendar year 2018 or fiscal years ending in 2019. For example, for calendar year organizations, the financial statements for 2017 will be the last statements prepared under current GAAP. Some of you may have already prepared your 2017 financial statements, and some of you are most likely preparing or getting ready to prepare your 2017 financial statements. After that, the next set of annual financial statements you prepare will be under the new standard. For fiscal year organizations, for example, an organization with a June 30th year end, you most likely have already prepared your financial statements for the fiscal year ending in 2017. You will have one more year of financial statements prepared under current GAAP for the fiscal year ending in 2018. For example, the financial statements for the year ending June 30th of 2018. You will then need to prepare financial statements under the new standard for the fiscal year ending in 2019. Keep in mind, you may need to implement certain changes as of the beginning of the year the new standard is effective. For example, if you are a calendar year organization that needs to make changes to better track expenses by functional categories, you'll need to start tracking as of January 1st, 2018. Other examples of items that may need to be tracked as of the beginning of the year are donor restrictions, board designations, endowment funds, and investment expenses. Finally, earlier adoption of the standard is permitted. However, you must apply all provisions of the new standard in the year of adoption. That is, you can't choose to early adopt only parts of the new standard and wait until the effective date to adopt the rest. For example, you couldn't reduce the classes of net assets from 3 to 2 and delete the disclosures related to investment return, but not include the analysis of expenses and the disclosures related to liquidity and availability of resources. However, there are a number of changes you can currently make without adopting the new standard because they are permitted under current GAAP. For example, you could include in your financial statements the enhanced disclosures about designations of and restrictions on net assets, the disclosures related to liquidity and availability of resources, the analysis of expenses and disclosure about allocation methods, and your spending policy from underwater endowment funds. In fact, there are only 4 changes that require adoption of the new standard. They are presenting one class of restricted net assets, the accounting for underwater endowment funds under just the 2 classes of net assets, eliminating the disclosures related to investment return, and eliminating the reconciliation from the statement of cash flows if the direct method is used. The second point about adopting the standard is that the provisions of the standard should be applied on a retrospective basis in the year of adoption. Now, what does that mean? Retrospective application means that if prior periods are presented with the current period's financial statements, for example, many organizations prepare comparative financial statements that include the current year and the previous year, the new accounting principle should be applied to the prior periods as if it has always been used. For example, let's take a look at Exhibit D on page 4 of the exhibits. This exhibit illustrates comparative statements of financial position presented in accordance with the new standard. Thus, the net assets section has been changed to include only the 2 classes of net assets, with and without donor restrictions. Assuming the year 20X1 is the year the new standard is first adopted, the net assets section of the prior year 20X0 statement of financial position has been adjusted to present just the 2 classes of net assets. Finally, in the year of adoption, the organization should disclose the nature of any reclassifications or restatements and their effects, if any, on changes in the net asset classes for each period presented. So, in the year of adoption, every organization's financial statements will include a change in accounting principle disclosure that, at a minimum, indicates the new standard has been adopted. Other than changes to the net asset classes and possibly reclassifying investment expenses to net them against income, there are not going to be many reclassifications or restatements since, as I mentioned at the beginning of this presentation, the new standard primarily just makes changes to presentation and disclosure, not how transactions are recognized. And finally, the new standard does provide some transition relief for those organizations that prepare comparative financial statements. In the year of adoption, an organization has the option to omit the information on this slide for any prior years presented for comparative purposes. The first is the analysis of expenses by functional and natural classifications in one location. The exception is those voluntary health and welfare entities that are currently required to present a statement of functional expenses. Those types of organizations must still include the analysis for any prior periods presented. However, they can present the analysis as a note instead of a statement if desired. The second is the disclosures about liquidity and availability of resources. Now, in years subsequent to the year of adoption, this information is required for all periods presented. So some of you might be wondering what some of the disclosures might look like in comparative financial statements. For example, if we take a look at one of the examples of disclosures about liquidity and availability of resources, this disclosure in comparative financial statements will probably still just be one note, but the table showing financial assets available for general expenditures would include both the current and the prior year. There would most likely be just one narrative if the organization's policies and practices are applicable to both years. So what might be some overall strategies for implementing the new standard? You could start by taking your last set of annual financial statements and recasting them for the new standard, identifying what information is currently available and what information needs to be gathered. You could also test drive the new standard by preparing or including changes that can be implemented without formally adopting the standard. And with that, I'm at the end of my presentation, so thank you for listening. This slide includes my contact information. You can also contact our firm through our website as well as follow us on various social media platforms. Again, thank you, and let us know if you have any questions.